Welcome to Business Weekly. Monetary policymakers in Great Britain decided to play safe. Despite recent signs indicating the country is ready for recovery, recently appointed Governor Mark Carney promised to keep interest rates low as long as unemployment remains high. Apple and Samsung are at odds with each other yet again, though this time the patent war that has been waged for more than 2 years could turn geopolitical, as an intervention by the Obama administration in favor of Cupertino prompted a strong reaction from the South Korean government. Let's stay in the U.S., where there is big news for news. The Washington Post newspaper, a legend of print media worldwide, has been acquired by an internet pioneer, Amazon founder Jeff Bezos. Was the billionaire looking for a new hobby, or is there a hidden agenda behind the move? We'll discuss the week's top stories with Bloomberg's Jonathan Farrow, but first let's see what Britain's central banker said in his first news conference since taking office.
Jobs are central to the Bank of England's new policy strategy, which includes keeping interest rates at a record low until unemployment falls from the current 7.8% to 7% or below. Economists say that's unlikely to happen for another 3 years. Unveiling his much-anticipated forward guidance plan, new Bank of England Governor Mark Carney said Britain's economic recovery is underway and seems to be broadening, but has a long way to go. So the Monetary Policy Committee is keeping the option of printing more money to buy bonds and stimulate the economy.
While the unemployment rate remains above 7%, the MPC stands ready to undertake further asset purchases if further stimulus is warranted. Our aim is to help secure the recovery while ensuring that risks to price stability and financial stability are well contained.
The bank said Britain's economy strengthened over the past 3 months, but the recovery is much weaker than in the US or Germany. Carney called it the slowest recovery in output on record. The financial markets also noted the bank gave itself a get-out clause, saying it could put up interest rates to keep inflation in check, even if unemployment is not falling.
Reactions were not exactly what you would expect after the first major move of the man called the outstanding central banker of his generation. The London Stock Exchange was the worst performer in Europe following the announcement. Jonathan, why are investors skeptical?
Well, Alexandra, let's start with what the central bank has done. Interest rates have now been linked to a threshold, so taking a leaf out of the Federal Reserve's book, we can now expect no rise in interest rates until unemployment hits 7%. The idea is to give me, you, your viewers, those sensitive to rate rises, some confidence, take away the uncertainty that interest rates may rise soon. It's a way of stimulating economic activity. But there are two issues here. And if you look at the United States, for example, on unemployment, is it really a read into the strength of the economy or a reflection of the health of the labour market? You've got to take account of the participation rate. That's been very low in the United States. People may have just stopped looking for work. Then you've got what's called underemployment, those in part-time jobs who would actually like a full-time job. Now, neither of those two things paint a picture of a strong labour market. And secondly, you've got the issue of inflation. Policymakers indicated the commitment is voided if policymakers decide medium-term inflation is likely to breach 2.5%. So many investors, many analysts are asking, does that undermine the whole process of forward guidance? How reliable is that commitment to low rates? And that's why a few people are still quite sceptical.
Last time it happened was the 80s, when Ronald Reagan issued a veto on a ruling by the U.S. International Trade Commission. His intervention enabled Texas Instruments to keep selling its products despite of intellectual property complaints by foreign companies. The same thing just happened, only this time the contenders are warring tech giants Apple and Samsung.
The global patent war between Apple and Samsung, the world's top two smartphone and tablet makers, has turned political. South Korea's government's expressed concerns about the surprise decision by President Obama to overrule a sales ban on some Apple models. The ban was imposed by a US trade panel. It applies to the import and sale of some older iPhones and iPads on the basis that they infringe on one patent owned by the South Koreans. The White House reversal of that ruling at the weekend led to accusations of protectionism from the South Korean and media. As of April this year, Apple has just over 39% of smartphone sales in the US. Samsung handsets accounted for 22%. Worldwide, Samsung's overtaken its US rival. South Korea's Trade and Industry Ministry says it is closely watching the next trade ruling due this Friday on whether some Samsung devices violate Apple patents. It says it hopes that will be made on, quote, fair and reasonable grounds.
Jonathan, the Obama administration said the goal was to protect U.S. customers' market choice, while the South Korean government called it plain and simple protectionism. Should we expect a diplomatic escalation on this one?
Well, this is very much an ongoing story. That news was just the latest twist in the patent war we have seen between these two companies. They dominate the smartphone market, a market that was worth $293.9 billion just last year. And the iPhone is a big part of Apple's business. It made up half of the company's revenue just last year, so it's a battle they are likely to continue to fight. Now, at a diplomatic level between South Korea and the United States, there isn't a lot of evidence of that escalating right now. But at the corporate level, well, the sense among investors is this is likely to continue. Just a week after Apple dodged that iPhone 4 ban, well, Apple is now trying to force Samsung's mobile devices off store shelves. The company is set to ask a US appeals court to block some sales of Samsung models based on a violation of Apple patents for its look and for its features. So while it may not escalate diplomatically, there's no real signs of this conflict disappearing at a corporate level at least.
The Washington Post, the newspaper that in the 70s managed to bring down a U.S. president, raises the white flag. The owners just could not keep up with the changes brought about by the advent of the internet. In an ironic twist, the print media legend will be now owned by a man who made his entire fortune on the web.
A trophy purchase or a chance to breathe new life into the Washington Post, one of the world's most famous newspapers. Amazon founder Jeff Bezos, who made his vast fortune from internet retailing, will take over the paper at a time when print is suffering from a decline in advertising revenue and readership. The Post's past is well known. It's the paper that brought down a president, discovering the Watergate scandal that led Richard Nixon to resign. But its future has been less certain. Bezos has the means to re-envision the business model of a struggling industry. His personal fortune is estimated at $25 billion. But does he have the vision? The Post's parent company makes a profit from many other ventures, including cable TV, but its newspaper division lost nearly $15 million between April and June. Print advertising revenue continued to decline. It fell 4%, while sales of papers were down more than 7% in the first half of this year. Bezos has promised changes without giving details, adding, "We'll need to invent," which means we'll need to experiment. Many newspapers have been experimenting with means of surviving in the internet age. Can he find the magic formula? It has been noted that with this purchase he gets a lot of information about the Washington Post's readers, perhaps useful in figuring out what they might want to buy.
For several years now, people have been predicting the complete death of print newspapers within the next 30 years. Jonathan, why do you think Jeff Bezos decided to buy the Post? Is he just a bored billionaire looking for a new challenge?
Alexandra, this is a man worth $27.5 billion by Bloomberg's estimates. So that $250 million price tag for the Washington Post is unlikely to do much damage to his bank account. So the question is, why would he want a newspaper, irrespective of how much it costs? Now, the death of print newspapers, that is something you hear about a lot. But remember, this is the man that founded Amazon. That company transformed the book industry. We're seeing a shift from traditional books to digital versions available on e-books. And many expect him to try to do the same with the newspaper industry as well, and that's going to be quite interesting.
That was Jonathan Farrell from Bloomberg. Thank you, Jonathan.
Alexandra, my pleasure as always.
That's it for now. Looking ahead, on Monday, Greek economic growth in the second quarter is revealed. The day after, we'll find out how German steelmaker ThyssenKrupp fared in its third fiscal quarter. GDP first estimates for both Germany and the Eurozone are released on Wednesday, while on Friday, U.S. retail giant Walmart publishes its latest results. Thank you for watching and see you soon.